My guest today on the 25th episode of the Sensei Kujaku Show is Professor Aswath Damodaran of NYU Stern School of Business. Professor Damodaran is often referred to as the Dean of Valuation and teaches courses on corporate finance and valuation. He writes extensively on a variety of topics relating to finance, and his views and valuations of equities are widely followed around the world. On this landmark episode of the podcast, Professor Damodaran was his usual eloquent self and spoke extensively on topics relating to business, investing, and beyond. I hope you enjoy our conversation as much as I did. Hi, Professor Damodaran. Thank you so much for coming on. Welcome to the Sensei Kujaku Show.
Thank you for having me.
Professor, the theme for today is putting lipstick on a pig, or in other words, how to perpetrate a scam in 2024. And what I really want to talk about is what I think is a somewhat underserved market in the podcast world, which is how to actually do the wrong things and make people fall for your scams. Everyone loves talking about Buffett and Munger and all the right things that they should do while investing. So I thought, why not serve the other side of the coin, which is people who just want to make a quick buck. And the first question that I have for you is that if I asked you what is the most effective way to perpetrate a scam in 2024 in terms of, fooling investors or the public at large, what do you think is the most effective way to do that?
I'm going to start by disagreeing with you on a basic premise. I think 95% of the stuff you see on markets, not just on YouTube, but on CNBC, is designed to play on people's need to get rich quickly. In fact, when people talk about being in the market because they want to get rich quickly, they're already well on their way to being scammed, because that is the pathway to getting scammed. And here's why. Now, if you want to get rich quickly, you are going to overreach. You're going to try to I'll give you an easy way that you can think of trying to you pick the biggest winner and you ride the winner. You said, I could have made 10 times my money. So you know what you do? You try to find the next big winner. And you put all your money in that winner, and then you wait for the 10 times payoff. And 95% of the time, 98% of the time, you end up losing half your money or all your money. So I think the first thing to remember about scams is scams are like, tango dancing. You need a partner. For a scammer to win, you need a scammy. And you need people who essentially are. So I won't blame the victim here, but the victim is very much part of the scam as well. Scams work because people get greedy. And when they get greedy, they get blind and stupid. Take every scam. I'll give you an example. Why did Bernie Madoff pull off what he did? This was a guy whose clients were very wealthy, self-made business people, bright people. They've been successful in businesses, and they fell for a scam. His scam was a very simple one. He said, I can make you 8% guaranteed. He was clever. He wasn't saying 80% guaranteed, because then he'd have got suspicious, 8% guaranteed. That is well above what you could make on a treasury bond at 5%. People said, that sounds good, but not too good to be true. Yeah. And he pulled off that scam because people fell for it. So if I wanted to devise a scam, the first thing I would do is I would devise in a way where it doesn't overreach. I won't promise you 800% returns. I'll promise you 12% returns guaranteed. And every scam then requires the engine keep running. More money has to keep coming in. So as long as the money keeps coming in, I use the new money to pay off the old money. And every scheme at its heart has a Ponzi scheme component to it. Yes, and so a Ponzi scheme is new people pay for the old people. And India's seen its, hundreds of variants of this in chit funds that used to be run 40, 50 years ago, where people would collect money, they'd promise 15% returns and collect the new money to pay off the old money. And the scam continued as long as the growth continued. Eventually, all scams blow up because new money stops coming in. So I think that scams work because we think of investing as a way of getting rich rather than as a way of preserving and growing wealth. And I tell people that is the healthiest thing you can think of in investing. Investing is not about how do I get rich? It's how do I preserve and grow wealth, which is bad news, right? Because you need to get the wealth from somewhere. So I tell people, if you really want to have investing work for you. Go get a job, get an income, because you need to build up wealth. If you're a doctor, don't spend all day reading what the market is doing and where to put your stocks. Just be a good doctor. That's going to be the basis for investing. But we're impatient. We want to get rich quickly. We want to be billionaires, not even millionaires anymore. And we overshoot.
It's interesting you say that. So, I mean, there's a lot to sort of unpack from your answer. Just taking off from the last point, it's amazing that I see. I mean, I suppose I'm the wrong guy to talk about this, considering I'm one of them. But so many people leave whatever it is they're doing otherwise, and they've sort of moved into the markets full time over the last few years, and leaving good, decent jobs in some other field, thinking that I can make 50, 60, 70% a year. Why should I work for some other guy 12 hours a day? Just be my own boss for 6 hours a day and make 70% a year. So it's interesting that you talk about that, and that's exactly the kind of market that the investor that I'm thinking of, where there's such a desire, not explicitly but subconsciously, that you almost want to be fooled, that you want to believe, you want to sort of buy into the magic that someone is displaying in front of you, right? You want to fall for the trick. But what I want to understand is if you've ever thought about, maybe a scientist or a biologist is maybe the right person, because maybe it has something to do with the wiring in our brains. But why is it that people are so desirous, even if it's at a subconscious level, of falling for that? So I think of, for example, the Madoff example, you think of SPACs, but there's a million other examples, and sophisticated investors. Why are we so desirous of falling for things that we know are too good to be true?
Because we want to live in the world we wish we were in rather than the world we're in, right? The fact is, reality is a tough grind. And when reality is a tough grind, human beings, and this is our survival mechanism, right? Because you face up to reality day after day and you say, look, this is depressing. The way you create that alternate world is by imagining things that don't exist, right? There's a reason. I mean, you've seen a Bollywood movie, right? It always, there's 3 hours long, there's plenty of, it always has that ending that makes you feel good. Now, investing becomes like a Bollywood movie, which is you think it's scripted, it's going to end well, so you enter it, hope in the back of your mind that this isn't a Bollywood movie. But I think you're right. It is human nature, which is one reason when people, after every scam, you know what they say, right? Never again will I fall for something like that. My reaction is, no, I'll come back with those words 7 or 8 years from now. We seem destined to repeat this process because it's built into us. So I think it's, I'm not saying that this is why I think legal, solutions scam. We're going to ban them. We're going to never work, right? Just like, we've tried to stop gambling, which ultimately, if you think about gambling, why do we gamble? The expected value of gambling is negative. We know that walking into a casino, but we do it anyway. We do it all the time. So it is human nature. And I think the one thing is, the less hope you have in the future, the more you're going to gamble. It's one of the great ironies as to why the people who can least afford it end up being the biggest buyers of lottery tickets. Because to them, this is their only chance. It's a minuscule chance. They're not being irrational. They're saying, there's no chance I'm going to break out of this existence I have where I'm living, hand to mouth, salary check to check. This is my only chance. You can't begrudge them that chance, but it also means that the people who can least afford it end up being the biggest targets of lottery schemes. In the US, though, they're run by governments. The government effectively is, this is the most regressive tax you can think of, is taking advantage of the least, the least fortunate among us and holding out. And if you look at the size of lottery winnings in the US, they can get to 100 million, 200 million, 500 million. The larger the number, the more good sense goes out of the window, because you can become a billionaire if you get the right ticket.
Absolutely. It's absolutely, it's in some ways sad, and it's a major question all governments have to ask themselves, that something like gambling, in whichever form it may be, that whether the economic benefits of it in terms of, casino employment and, entertainment and whatever you want to call it, whether that actually outweighs the societal negatives of that. But Professor, I want to come back just to the earlier question that I had in terms of actually perpetrating these scams. I want you to, for a second, imagine that you are the CEO of a company and of a listed company. So every 3 months, you're putting out your financials and you're feeling a lot of shareholder pressure to make things look better than they actually are. And to make things easy, let's take a very basic manufacturing company. Let's imagine you're manufacturing t-shirts and distributing it to someone who eventually sells it in their store. What would be your first port of call in terms of manipulating the numbers to make them look better than they actually are?
Since I'm usually on the other side of the table when this happens, let me at least give you a sense of what I've seen play out. The first is you're going to go to your accountant. If your accountant is an old-fashioned dot every I, cross every T kind of guy, usually it's a guy, older, you fire that accountant, hire a younger, more creative accountant, right? And what that younger, more creative accountant does is he says, you know what, there are accounting rules, but there are flex in them. So initially, you're not even breaking the law. You just say, look, if I can move an expense from the operating expense column into a capital expense, it's going to make my income look higher. So that's your first stop. Get the accounting working so you're earning. Then the second stop is with the marketing guy. You know that when you sell something, you record it as revenues right away, even if you don't get paid. So you encourage that marketing person to sell more stuff, even if it means non-credit for 2 years, 3 years. You record the revenues. You report high earnings, even though your cash flows are awful because you're not collecting the money. Your third stop is, you go to your strategy guy and say, what can we throw into our story about the company that'll make people more excited? In 2023, the word that would have come to mind is AI. You're a manufacturing company, you have nothing to do with AI, but you throw in an AI component to your story. You talk about, even though in Kroger's, for instance, I'll give you an example. Kroger's, this is not about fraud, but Kroger's it's a grocery store. And last year, on their last earnings report, they mentioned AI 13 times in the context of a 20-minute call. Now, NVIDIA talking about AI makes sense. This is a company that actually makes money on AI chips. What does Kroger have to do with AI? So you throw in a few words, and the words have shifted, right? In the 1990s, you put in a .com in there. And last decade, you talked about a platform, even though you had no platform. You're a manufacturing company. What's a platform? Today, it's AI. You throw the buzzword in. And then you got to sell the story. It's very difficult to perpetrate a scam as a CEO if you're not a good storyteller. The very best scams come from CEOs who can go out there. They share a lot with, India is a share of holy men who go out and kind of perpetrate frauds. What you do is you tell a big story, you when you think about what connects stories, it's sex, salvation, or stocks. Basically, it's, can you make money? So you figure out a way, in this case, that you can make money. You make the story about you can get rich in my company. And then you wait for the people to come in, and then you let momentum play its story. As they come in and they push up the price, use that to push up the story even more. And then you stay one step ahead of the story until the story runs you over, as it eventually will.
Right. And in such situations, if you take the three most commonly used operating metrics that investors use, which is ROE, ROIC, and ROCE, what do you think, in your opinion, is the best way to manipulate those? Because often people use them as shorthand for judging whether a company is good or not.
Work on the denominator, right? Denominator is an invested capital employed. It usually comes from balance sheets. If an item is not on the balance sheet, it's not in your capital employed. I'll give you a game that people used to play. It's not as effective anymore. There was a time when if you leased an asset instead of buying it, it didn't show up on your balance sheet because lease expenses were treated as operating expenses. So if you leased everything rather than buying it, your invested capital was a very small number. So when I did a return on invested capital, you look great, even though you were leasing everything under the sun, paying 50% more than you would have if you owned the asset. But you're taking advantage of a loophole in accounting. Now, today, for instance, accountants talk about intangible assets, but they're terrible about capitalizing intangible assets. So if you're a company and you acquire a patent, it's shown as an asset. But if you spend money on R&D to get the same patent, it just disappears into thin air. So you look for things where accountants either are inconsistent or just plain wrong, and you take advantage of them to reduce your denominator. You reduce your denominator, your return on capital employed or return on invested capital is going to do magical things. Now, the other metrics, of course, are margin metrics, operating margin, net margin. There, the game has to be around income. How do I make my operating income higher, net income higher? And there, the less you expense, the more you move to the balance sheet, the higher your income is going to look like. So again, you play that game. You do customer acquisition costs, you capitalize the costs, even though your customers never stay on for more than 2 weeks. All of a sudden, your margins look great. Your net margin looks great. You got assets that have really not assets in your balance sheet. So you tell me what your metric is. I'll play the game according to the metric to deliver a higher number, which means it's buyer beware. When you look at a company, you need to look at the metric and you need to look at the rest. I mean, the truth is there. You just chosen not to look for it. The company that sold things on credit will have a high income, but if you go to the statement of cash flows, the truth is right there. We just choose not to look at it. The company that pays stock-based compensation will report lower income. You know what analysts do here? They reverse the process, they add it all back, to which your response is, what are you guys doing? That is an actual expense. You have lower income. So I have very little sympathy for investors and analysts who do not want to do their homework, but want to complain after the fact that companies are misleading them. Yeah, they might be misleading, but you should know it's due diligence that you're missing here.
What do you think is the most effective way to manipulate the cash flow statement?
That's a tougher statement to manipulate. It's cash in, cash out. Luckily for companies, it's the least used financial statement. Yeah. There are a lot of people who don't even know the statement of cash flows exists or don't even know what it is, right? So what the heck is this? Income statements they get, the proverbial bottom line in accounting is still net income, earnings per share, operating income. When was the last time you saw an earnings call where people are asking about the statement of cash flows? I've never seen one. It's astonishing if you think about it. Netflix, even as it's reported positive earnings, has always struggled with its cash flows. But I never see analysts asking questions. The reason it struggled with its cash flows, its biggest expense is content costs, which sucks cash. It doesn't show up on the income statement fully. So their income looks good, but their cash flows have always lagged their income. Never seen anybody ask questions about it.
But don't you find that really there's an incongruity in the sense that if like these are the people who are using DCFs to value companies, and ultimately in a DCF.
Stop you right there. Who uses DCFs to make investments? I don't know of a single active investor, a mutual fund manager, who's building.
What do you think they use to value companies?
They're price companies. They use PE ratios, they screen for low PE ratios, high growth. They're pricers, which is fine. There's nothing wrong with it. But the notion that there are active investors who pick their stocks based on DCF, first, it's impractical. And here's why. You're an active investor, and I tell you that your universe is the 500 largest market cap companies in the US or India. You've got 500 companies in the universe. If you want to do a DCF-based investing, you'd have to value each company, not just once, but continuously. It's time intensive. Who has the resources to do it? Most, I would say 99% of mutual fund managers, active investors, base their decisions on pricing. And here's the other reason they base it on pricing. How do you get judged as a mutual fund manager?
Yeah, performance. I mean, monthly performance.
Against
the benchmark.
Against other portfolio. So basically, you're judged against other mutual fund managers. You're down 15%. You look like a hero where everybody else is down 20%. We get judged on a relative basis. We pick things on a relative basis. Pricing is how this game gets played. And there's a lot of delusion out there because a lot of people don't want to admit to that. Why? Because it's viewed as shallow. Everybody wants to be a Warren Buffett. Everybody wants to talk about intrinsic value, but talk is cheap.
What do you think of Warren Buffett?
I think he's been a great investor. You know what's made him great is he's had an investment philosophy that's his own, that he thought through, that he stayed consistent with for 60, 65, 70 years. Most active money managers have no philosophy. They do whatever worked last year. So they swing from one end of the spectrum to another. If you have if you believe in nothing, you'll fall for everything. And that's what they do every single year. And then they wonder why active investing as a profession has such a tough time kind of keeping up with the market with an index fund. You know, I admire Warren Buffett, but I also, and this, I think we do a disservice to him by putting him on a pedestal and treating him. I mean, if he lived in India, he'd be, he'd be elevated to God status. There'd be temples to Buffett where people would go to pray before they create their portfolios. And I think investors, when they raise him to that status, I think do him a disservice because he's a human being and human beings have blind spots. All human beings do. And we know what Buffett's blind spot is. He likes to invest in things that he really understands. He's been open about this, that he can see and understand. He likes the Washington Post. Why? Because he reads the paper. He likes the paper. He buys Coca-Cola. Why? Because you've seen him, with I think there are pictures of him in a diner with Bill Gates, and he has a big cola next to him. He bought See's Candy because he liked their candy. And he avoids companies where he says, I don't understand what they do. And it's been his biggest weakness, is the one sector where he's consistently underinvested is technology, right? He never invested in Microsoft in spite of having Bill Gates as a friend because he said, I don't understand what they do. It's not. And here's the problem. The older you get, the less of the world you understand, right? I don't understand this TikTok thing, right?
Yeah.
Who wants to watch it? But my kids love it.
Yeah.
Does that mean that that I should never buy ByteDance? I mean, it's the parent company for TikTok. If it went public, but that's the problem you have when you say I will invest in only with things I understand. So his blind spot has always been that he wants things that are on the ground right now. So he invests in mature companies and only in things that he understands, which means his universe has shrunk over time. There's a reason he thought Kraft Heinz was a good company in 2015. What does Kraft Heinz make? 57 types of ketchup that all taste awful. And cheese that stays liquid for the rest of eternity. I don't even know how you create cheese like that. Is it really cheese? You know who finds Kraft cheese to be good is people who are older. It has an older audience. People of 55, 60, 65. Nobody in the age of 25 says, I want Kraft cheese on my sandwich. That really tastes good. He missed that. He missed the fact that this is a company that had a brand name, but its brand name was aging. Its market was aging. He missed it because he was aging as well. I'm not saying this as a critique of Warren Buffett. I'm just saying he's a human being. He has his blind spots, sort of things he says where you got to, like everybody else, you have to stop and say, does that make sense? Does that make sense for me? Just because Buffett says it doesn't make it so. So I admire Buffett, but I admire him as a human being, which is, I think, the best compliment you can pay him, rather than say, I admire him because he's the superior person who can make these decisions. He's had to deal with his own issues. He wrestles with his own, limitations, and he's come out ahead. And for that, you got to give the guy immense credit. No.
Yeah. No, absolutely. I mean, without a doubt. And actually, now that we're talking about Buffett, and if I expanded to Buffett and Munger, so one of the things that Munger famously said in an annual meeting maybe 20 years back, somebody asked him about EBITDA and whether that's a useful metric or not. And Buffett, in his usual slightly more diplomatic style, sort of said, this is what I think. It's not.
Charlie lost his filtering mechanism about 50 years ago, so he's always spoken his mind.
And
Charlie goes right on and says, EBITDA is bullshit. Do you agree with that statement?
Well, bullshit is a really strong word. What is if you say earnings matter, if you said, so just because something is further up the income statement doesn't make it bullshit. Using it as your metric for buying a company and say, look, any company that trades at less than 6 times EBITDA is lazy, it's sloppy, it's stupid. And there are people who do LBOs. This is their only metric, because it's trading at less than 6. So maybe what he meant as bullshit is using EBITDA as your only metric for looking at a company and valuing a company based on you have a lot of EBITDA. is bullshit because you are not doing your job. That is not investing. That's so lazy and sloppy. You deserve to be taken to the cleaners. So I don't think EBITDA is bullshit. But using EBITDA as your metric and saying this company looks cheap because it trades at 5 times EBITDA and everything else trades at 8, which seems to be the extent of some equity research, I'm going to argue is bullshit.
In one of your earlier answers, you were talking about buzzwords, and I remember a talk you gave. I think it was at Google, where you were talking about it was a fantastic scene where you took out this cloth bag, and you're sort of I think the employees, and you start pulling out chits, and one of them is China, one of them is Synergy, and I forget some of the other ones.
Weapons of
And
mass distraction.
Exactly. So I want to know from you, sitting in early 2024, at the risk of asking you to stare into a crystal ball, what do you think are going to be the WMDs of the next decade?
Well, the worst, I think, and this is worse than the synergy and control and China, are words like ESG, sustainability, because they sound good. They come from virtue. And I call them the theocratic trifecta. Theocratic trifecta being ESG, stakeholder wealth, whatever that means, that you have to care about stakeholders and sustainability. I call them theocratic because there's an element of this is good. How dare you even push back against something that's good for humanity? Come on, if you're India based, we know people who clothe themselves in virtue, and we know in hindsight what we end up getting with people who clothe themselves in virtue is the exact opposite of virtue. So my fear is the weapons of mass distraction now have become words of virtue. And the reason that's dangerous is because pushing back is viewed as people don't want it. They're intimidated. Because if you push back, you're viewed as a bad person. When I wrote about ESG in 2019, I started from a position of curiosity. I wondered, how does an acronym that comes out of nowhere end up being adopted by the establishment? Because the establishment brought in BlackRock, Larry Fink, and as I wrote the piece in the first paragraph, I said, I'm probably going to be labeled a moral troglodyte for doing what I'm doing, but I'm going to do it anyway, because I think the weakest link in ESG is nobody has pushed back. I think the reason it's exceeded its mandate and done the things it did and put itself in the position it was in, where it essentially, kind of blew itself apart, because nobody was pushing back. So my worry is when I put my hand into that bag now, I'm pulling out words and I don't even know what they mean. The people who push them don't know what they mean. The next time you run into somebody who talks about sustainability, ask them a simple question. Sustaining what? I understand a sustainable planet. We're all on this planet. We want to sustain it. I even understand a sustainable product. Is that what you're talking about? That you want a company to make a product that lasts longer? But what does a sustainable company mean? Does that mean you want your company to last forever? That doesn't strike me as a good idea. A company is a legal entity. If the reason for your existence is gone, shouldn't you leave too? Do you want the East India Company still hanging around there? I don't. The reason for its existence was bad in the first place. It was a company running a country. The reason for your existence is gone. I want you to leave. So sometimes you push on these words and you recognize the people pushing them don't even have an idea what they're selling you on, but they want you to change the way you invest, change the way you run your company, because they throw the word at you. Don't you want to be sustainable? What does that mean? If you don't know what it means, how does it play out in my company? So my fear is the weapons of mass distraction have become more difficult to push back against, because they're wrapped up in virtue and climate change and whatever else global problem you think you can't be against stopping climate change. So how dare you produce fossil fuels? And this is coming from a society that gets 82% of its power from fossil fuels. The hypocrisy is rank. It just is disgusting in many ways. Because to point to companies as evil, when in fact you're completely dependent on this company producing. Last week I was talking to a student of mine who's now the CFO of a very large oil company, and he was frustrated. I said, look, you guys as oil companies need to get together and essentially for 6 months say, you think we're evil? Well, you're right, we're evil. We'll stop producing oil for the next 6 months. See what happens. What are all these sustainability people who live? They say, I drive my electric car. How the heck are you going to recharge your electric car? Where do you think the power for that comes from? I mean, this is like people who eat, steaks every day and complain about animals being killed, right? I mean, where do you think the steak came from, right? I think that I think it's actually worse now, the weapons of mass distraction, because at least in the old days when you talked about control, we could talk about real effects, how it played out in running businesses, synergy, even China. And the interesting thing about China is notice how a word can add value at a point in time, and 10 years later, it's now a discounting factor. Words can turn against you, right? China's gone from being a big plus to a big minus.
I'm based in India and a lot of our viewers are from India. Do you think, so in India, of course, there's tremendous excitement about the future right now. Given that you don't sit in India and you presumably have a slightly more objective view of things, how do you view India today as an investment destination?
India is an amazing position. And this is an extraordinary time for India because let's face it, now, if you think about the last 25 years, half of all global GDP growth came from China. China can't pull that off anymore. They're done. So the question is, who's next? And let's face it, there's only one candidate here. Can't be Brazil, it can't be, it can't be Eastern Europe. It has to be India simply because the numbers. It's not even something that India earned to get at the table. 1.5 billion people gives you a place at the table that no other country can have. It's well positioned, but it's not guaranteed, right? Things have to work right. And I think when I wrote about the Adani Group last year and people critique me saying, you're Indian, how can you say bad things about India? I said, I think it's precisely because I'm Indian that I want to push at what I call the weakest links in the India story. And in many ways, the Adani, fiasco, and I think it was vastly overblown by Hindenburg, because it is something that a lot of family groups in India do, pushes at the weakest links in the India story. The first is, I think that many Indian companies face the problem of they value control. The part of the India story is a lot of Indian companies are still controlled by a family group, by an insider, by an individual who doesn't want to let go. And that can create negative consequences. That was, if you think about the shell companies that Adani used, it was for stupid reasons to keep under the 75%. Remember, if you own 74% of a company, you have complete control. What's this fixation about wanting to control 78% of the company? What's the extra 4% doing? But with control, you can never stop. The second is it's a country where I think bureaucrats, some of them are corrupt, but a lot of them just don't want to make decisions. Because you get all downside, no upside, right? Because you make a bad decision, people pounce on you. You make no decision, then nothing happens to you. So everything gets pushed through. The old days, it was just files being pushed through by bureaucrats. In the new days, it's digital files being pushed through. And India has an infrastructure problem. We all know it. You know it the minute you step out of this office, because to get home, it takes you 4 times as long as it did 20 years ago and 10 times as long as it did 40 years ago. Why? Because the roads look exactly the same in Chennai, in the cities. I know the highways, have been upgraded. But when I go back to Chennai and I look at those roadways, they look exactly like the roads I grew up in the 1970s when there were, 1/20th the number of cars there. I mean, I'll confess, I don't much enjoy doing anything in India because everything becomes a production. Going to the restaurant becomes a 4-hour round trip, right? It's an hour and a half, and it's a 7-mile drive, but no, 5-mile drive. You're stuck basically. There's an infrastructure problem. And if India wants to step into the breach, those problems need fixing. We know it. We all know it. I know the government tries, but this has got to be something that is more systemic. It's built into every level. And it's got to be done faster. And in fact, the final thing about the Indian system is you've got a legal system that's incredibly slow to act. And a legal system that's incredible. And for any kind of organized functioning economy, you need a legal system that's not just effective but timely. So we know what the weak links are. They can be fixed. They'll need resources. And I think India, while its position, needs to work on its weakest links. Don't keep selling me that you have 1.5 billion consumers, that you have a middle class. I know that. That's your good side. I need to know what you're doing to work on your bad side, the side that is getting in the way of being the next great growth engine for the world. But I think India is uniquely positioned to be that growth engine. I'm upbeat about India as a country, but it doesn't mean I'm going to buy every Indian stock that comes along, because the market is already priced in that story. And when you're priced to deliver perfection, there's not much I can hope for as an upside, right?
Right, exactly.
Only bad things, only bad surprises can hang out there.
There's a fantastic line, which is that India disappoints both the optimists and the pessimists. And I think what you've captured is that exactly, right? That there's so much to be hopeful about, but still such a long way to go. And of course, I guess whether you're an optimist or pessimist determines that whether you complain about it or you see it as an opportunity, which obviously a lot of companies have, right? So infrastructure is such a large opportunity for many companies, and very large players entering that,
in a big way.
I think technology changed the business game in India, because for much of the 20th century, to be a successful business, you had to play the licensing game, right? The licensing game basically meant that family group companies started off at such a significant advantage that an entrepreneur was dead in the water. Technology started with a fresh slate. That's why if you look at the growth of India as an economy, you can trace it back to the Infosys, the kind of tech companies that took off. Because they did two things. One is they showed that entrepreneurs can get wealthy without the level of connection. I wouldn't say without connections. India is always about connections, but in the 20th century, the connections had to be family level connections, and you weren't born into the right family in a sense. It almost made it, that's changed, and that's a good thing. And I think sometimes we forget how much has changed for the good, because perspective, I mean, the advantage I have is I fly to India 1 week every year. The India I left in 1979 is still the India that frames references for me. So I can see the things that have changed, how they've changed for the better or the worse. I mentioned the traffic as being for the worse, but there are lots of things that have changed for the better. There are lots of things Indians should feel good about that have changed over the last 40 years. In the last 40 years, more people have been moved out of poverty in India than in the previous 2,000 years put together. Something fundamental changed in India. And I think that that's got to be celebrated, even as we start asking the question, what do we need to do better? I think we need to think about the things that have changed for the better.
I think you're right. The public digital infrastructure, for instance, like UPI and things like that, have just been. I mean, I know you've spoken about it. Absolutely incredible drivers of growth and just economic empowerment. And
But India should probably pay a dividend to Reliance Jio. Every company, every Paytm, Zomato, because the smartphone has kind of released a lot of people from a lot of different constraints that they operated under. And it's something that governments need to factor in. The old days, the news was controlled, the information flow was very strictly regulated. So this is like riding the back of a tiger. As long as you're on the back, you feel pretty good, but be careful, the tiger might eat you.
Kind of reminds me of Bezos when he was talking about when he first started Amazon and how indebted he feels to FedEx and UPS and the postal service, because until someone built that, there could have been no Amazon.
Yeah.
Exactly.
We stand on the shoulders of the giants who went before us, and in a sense, I think we underplay how much being at the right place at the right time is what created the great companies of today.
Right.
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 And I blame places like Harvard that kind of take these companies, make case studies, and make it all about so Jack Welch who built GE. It was, Jeff Bezos' genius. And I think the truth is they brought something to the table. They were significant, but they also happened to have luck along the way. It's what they did with the luck that made them different. I mean, I give the example in my class of you're walking through Penn Station in New York, you find $100 bill on the ground. There are two things you can do. One is you can pick it up, walk into the restaurant, have a huge meal, drink as much as you want, spend $100, and you had a good time that evening, but it's done. The other is you can take the $100 and put it into a stock you've always wanted to buy two shares, but no. It's what you do with luck that separates the great companies from the average companies. Every company gets lucky at some point in time. The great companies take advantage of luck. I call it optionality. The average companies take the luck. They use it up very quickly, and then they're back to being in the grind. So, and that's true for investors as well. If you get lucky, remember you got lucky. Don't, I mean, there's an old saying in Wall Street, don't mistake, luck for skill. I mean, and people do it all the time. You get lucky, thank the Lord you were lucky, and then take full advantage of what luck gave you to build the next step.
Yeah, absolutely. And talking of investing, I actually want to take this chance to ask you about your own initial phase of investing. Do you remember the first stock you ever bought?
Before I bought a stock, I actually bought an index fund. And I'll tell you why. When you start investing, it's good to start with the base of an index fund. Now, this notion that diversification is an ally. It's not something Harry Markowitz in Modern Finance discovered. It's always been true. I mean, the proverb of don't put all your eggs in one basket wasn't concocted 70 years ago. It's been around hundreds and hundreds of years. So diversification is something that you ignore at your own peril. So you don't want to give up on being diversified when you start picking stocks. And the people often ask, well, how am I going to pick enough stocks to get diversified? And I said, that's easy. Get diversified first and then go pick stocks. So my first, I don't know, 250,000, I actually bought index funds of various types. I got the base. And then I said, okay, for my base, I am diversified. Now I can afford to add individual stocks. So when I add a $25,000 stock, it's not the first $25,000, it's on top. Yeah. Very, very first company I bought was actually Apple in 1980 something, 81. No.
Yeah. Yeah.
And I bought it because I liked its products for all the wrong reasons. And I think, in a sense, I started there, and then I learned that you can like a company but not like it as an investment. And I think that's the healthy. When you get to that point in investing, you're starting to become a healthy investor. You're investing in companies you don't like because the price is right, and you're not investing in companies you like because the price is wrong. I love NVIDIA as a company, but I'm glad I bought it in 2018. I wouldn't buy it now at $600 per share. In fact, I'm supposed to speak on CNBC of the big seven, the seven companies that carried the market last year. I own six of the seven, but I didn't buy them last year. No, Microsoft, I bought in 2014, when the transition happened from the old guard of Steve Ballmer to Satya Nadella, and I liked what he was talking about, and I made an early bet, and it's paid off big time. I bought Apple 6, 7 years ago in one of those periodic bouts of this is the end, which it goes through. But I own six of the seven. I know the CNBC anchor is going to ask me, are you telling people to go buy these companies now? And I'm going to tell them, look, at today's prices, I wouldn't buy any of these companies. Which raises an interesting question. Why do I have one set of rules for companies I've planned to invest in and another set of rules for companies I've already invested in? Because if these companies look overpriced to me today and I'm not buying them, you say, why aren't you selling the stocks you have? Because they're overpriced. And the answer is twofold. One is a very pragmatic one, which is if I sell these companies, I'm going to face what I call the price of success, a capital gains tax, which in the state I live in is going to translate to about 25% of whatever I've made. So that's got to be factored in. The other is, psychologically, I like having these companies for the long term in my portfolio. For periods, I know they will get overvalued, and I'm willing to let them ride during those periods, because if I sell them, there's a very real chance they won't make it back to my portfolio. One of my big regrets I've always been open about my regrets, is in 2019, I bought Tesla at $180 per share because I thought they were undervalued. And I call that the post I wrote when I bought it. And I always write about the things I buy and sell when I do. The post I wrote, I called it my corporate teenager. I said, look, I'm buying Tesla. I'm buying it with open eyes. It's a company with a lot of potential, but like teenagers all over the world who look in the mirror every day and say, I have lots of potential. What can I do to screw it up? This company is going to frustrate me. It's going to frustrate me because it's going to step on its own storyline. And it's not even an it, it's a he who steps on the storyline with Elon Musk. The man is a visionary genius, but he steps on his own storyline constantly. That $180 became almost $600 6 months later. And I revalued it and I sold the company because it was overvalued. And I wish I had left it there because it had ups and downs, but eventually, long term, I'd rather have Tesla in my portfolio than Volkswagen because the company keeps pushing the limits of what can be done. It changes the story for an entire business. It's a special company. You might not like Elon Musk, but this is a company that is a company that should be in the case studies as a company for the century, a company that's one of a kind, that is a company that's so you know these companies because the way they're described is usually other companies describe themselves as the next this company, right? The Amazon, next Amazon, the next Amazon, the next Amazon. Guess what? There's only one Amazon. And I don't think a company can replicate what Tesla did because it was truly, I mean, it was at every step of the way. They took what looked unlikely or even close to impossible, and they brought it within the realm of it can be done. That's when people talk about automated driving. It's never going to happen. Tesla's barking up a tree. And I remember other things that Tesla's done over the 15 years lifetime where people said that'll never happen. No, who'll buy software for automobiles separately? And Tesla said, try us. No. So I start with a presumption when Tesla tries something that there's a chance it can pull it off, whether it's ride sharing or automated driving or software or robots. And that changes your story and investing for a company.
It's
Interesting the point you're talking about right now. Someone once asked Munger, if you're not willing to buy a stock at a given price because it's too expensive, by definition you should sell it. And his response was quite interesting. It was, you get married with both eyes open, but you stay married with one eye closed. And it's a fascinating thing, and it in a sense boils down exactly what you said.
It's a good psychological experiment. If we remove the capital gains taxes, why is there a difference? But there is a difference. I know there's a difference. I'm open about talking about the difference. So last summer when I valued NVIDIA and I came up with, because I bought it in 2018 at $30 per share, the stock was at $400 per share, nothing to complain about. Valued it at $240. I sold half my position, which sounds incredibly strange, but I said, look, this way I get to have my cake and eat it too, psychologically. If the stock keeps rising, I can point to the half that I held on to. Say, look, it worked. If it drops, I can put. You're saying, but what cycle? Because as investors, you got to live with yourself. You got to be comfortable with your decisions. And I know that being uncomfortable with the decisions leads you to get irrational elsewhere in your portfolio. So I was open about the fact I know I'm splitting the difference. I know it looks like I'm violating the principle of buy when it's cheap, sell when it's expensive. But I have to look in the mirror a year from now, and I don't know what NVIDIA is going to be. And I want to make sure that I feel okay with the person looking back at me with the choice that I've made.
Professor, listening to you now and obviously over the years, not only listening to you, but even reading, the many things that you put out, the thing that very obviously strikes me is the effectiveness with which you communicate, both written and oral. I want to understand from you whether that skill of communicating, which is obviously so important no matter what you do, how much of that is, do you think, something that you have very consciously worked on, and how much of it is just a God-given gift?
I mean, we talk about luck, so let's be quite clear. I was born lucky in terms of being able to structure thoughts and present them. But I'll tell you what makes communication more effective is if you're comfortable with what you're communicating. You actually have to be clear. So when you talk about something, you want to know if you're still doubtful inside about whether what you're saying really makes sense. I mean, you can be a great communicator, but you're not authentic. To me, the definition of authenticity is you reach a point where you can say what's on your mind, and if you are if you really believe it, that's what's coming out. So that's why I'm open about the fact that when I'm uncertain, I tell people, look, I'm uncertain, but I have to make decisions. The way I see it is I have to make decisions in a world where I'm still uncertain. If I wait for the uncertainty to go away, I will never decide. So investing is all about deciding with insufficient information and with the game still in process. So that essentially also means that I feel completely comfortable taking a point of view. I often think academics, cop out with this one on the one hand, on the other hand, discussion. A lot of academic discussions of valuation is, and I would blame bankers with the same thing, or equity. On the one hand, it could be worth a lot, on the other hand, it could be worth very little, and I have a range here that I can give you. No, you know what? I have to decide at a price. The price, unfortunately, doesn't give me a range. I either have to buy or sell. And that requires that I have to make a judgment call. So I've never felt queasy about telling people I am buying the stock, and I'm buying it in spite of the fact that there are lots of things I'm uncertain about. So I think if you're willing to be open, I mean, when I teach, my job is to give people kind of exposure to how I think through the answer to a question. Not just the answer, but how I think through. So when somebody asks me a question, rather than say yes or no, do this or do that, I take them through the process of this is how I'm coming up with this answer. And this is what I think the answer is, because that's what learning should be. It's about learning a process of thinking through a problem. Because let's face it, when these students leave my class, there's no way I've answered every question they're ever going to run into, because the questions will change, the world will change. But if I give them a process of thinking through a question, they will be able to use that process to answer questions. I don't know whether I succeed or not, and I try in valuation to do the same thing. I say focus less on the end product or what I got as my value for Tesla. It's $183. You can focus on that. But rather than focus on the number, focus on the story I'm telling, the way I'm coming up with the value. Because that's really what I want you to be able to replicate by yourself on Tesla or in any other company. So I think it's about, to me, communication is about revealing the insides of your thought processes, which means you got to have a thought process that you've structured through. And I'm lucky. That's where I was born with a structured mind, and I think through problems and I can structure them in my mind. I can create flow charts when I look at a paragraph, and that flow chart is what you see as communication when you listen to me.
You're talking about academics and sort of waffling, and there's this fantastic joke on economists. It's an economist is getting married, he's at the altar, and the priest says, do you take this woman to be your lawfully wedded bride? And he said, it depends. And so it's interesting when you think about, like you said, it's actually true now that you mention it. It's so much of academics and just life generally. I don't want to attack academics, but
they want to be right no matter what. And that's part of the problem is we value being right so much we're afraid to take a position would be wrong. And I've told people this long time, and I've struggled with putting into practice even in my life. The three most freeing words in life are I was wrong. Because until you say those words, you cannot re-examine something that you put out there that you know is untrue, that doesn't hold up. So in valuation, you hear me say, I was wrong about this company. And here's what I think about the company. People say, aren't you uncomfortable that your story changed and intrinsic value changed? And I give them the same answer that Lord Keynes gave somebody. He said, aren't you uncomfortable that you've changed your mind? He said, no, I'd be uncomfortable if I did not change my mind, given the circumstances changing around me. Is the world different now in 2023 than it was in 2020? And the world different in 2020? Absolutely. The world is changing around you. How come you're so sure about the right answer to every question that you formed, what, 1986 or 1975 or 1995? So to me, because I'm okay being wrong, I feel completely okay putting out my thoughts and this is what I think, say. And I tell them up front, look, I'm going to be wrong 100% of the time. That's okay because I'm not God. I'm trying to make my best judgments given the information I have. And being wrong is part of decision making in the world we live in.
Right. And Professor, you
In one of your earlier answers, you were talking about a former student of yours who's now CFO at a large oil company. And that got me thinking, when you look at, over these, I don't know how many, 30 years, however long you've been teaching, 40 years, yeah. You've obviously, you would have seen all sorts of students. Have there been cases where, when interacting with them in class or otherwise, it sort of immediately struck you, this guy is out of the ordinary, this guy is going to be somebody?
You know what? Students who impress me are students who are comfortable in their own skins, which is, because we all have ours, especially at 23, 25, you're still working. There's some people who are, supernaturally, they've come to peace with themselves. It takes, I think life is about being okay with who you are, getting to that point. A lot of people never get to that point before they die. So the students impress me are not the students who tell me, look, hello, I made 5 million trading, or I started my own company, or I understand this model really well. The students who are comfortable enough with themselves that they can tell you, I don't quite understand this. I don't agree with you on this one, because it takes a lot of courage to go up to somebody that you think is a subject expert and say, I don't think your story for Tesla holds. And that suggests to me that you're okay with who you are, that you're okay with pushback, that you're okay with debate. And I think, I have this adage of, you can disagree without being disagreeable, and that's fine. So the students who impress me the most are those students who kind of know who they are okay with who they are, and will keep moving through life. And I look at those students and say, you're going to be okay no matter where you go and what you do, because you're okay with yourself. Because when you're okay with yourself, you don't take it out on people around you. The people I think are the most unpleasant people to work with are people who are not okay with who they are. And then they take it out on everybody around them, because everything becomes somebody else's problem because there's something inside you that you're not comfortable with. I would be lying if I said I'm completely comfortable with who I am. I have parts of me that I'm still wrestling with. But to me, that is a lifelong mission, is you got to be comfortable with who you are and what you are, and live life on those terms.
right. And
It links so well with what you said earlier about authenticity. It's that authenticity does show itself one way or another. It's tough to hide it for a long time.
Right now, political consultants tell politicians you got to be authentic, which strikes me as the most inauthentic thing to do, is to try to get people to be authentic because it'll get them more votes. So I think, unfortunately, we live in a world where authenticity has become another weapon of mass distraction, which is founders are taught how to be authentic in Silicon Valley. There are classes on, and when I look at the description of the classes, I have to smile, because it's the entire opposite of authenticity. If you've got to go to a class to learn how to be authentic, but no, it is what it is.
It is what it is, exactly. Professor, I have one last question, and this is, I don't know if it's an unfair question or not, and maybe I think it may be a little unfair simply because it asks you to, in some indirect way, compliment yourself. But the question at a simple level really is, I want to know why you agreed to do this with me. You don't owe me anything. Your family's not held hostage at the back, but still, you, a leading expert globally on a very widely followed topic, took out time from his day when he had no obligation to do so, to talk to me, someone he didn't know existed till not so long ago. So my question is, why would somebody in your position take out valuable time to talk to someone and come on my podcast when there's really nothing in it for you?
You know what? You could argue that there's almost nothing in it for me when I go in front of my class anymore. I don't have to teach anymore. I don't have, but if you ever run into a Jehovah's Witness, they hand
I,
out free
I,
Bibles. And I've always wondered, why do you spend your whole life? You hang out in airports or in train stations, you hand out the Bible, most of the people who walk by you don't ignore you, but you spend all day there. And they have a mission, right? They do it because every teacher is a repressed actor. You want an audience, you want a bigger audience, right? And I like talking about investing. I like teaching. I like having an audience. And to me, I was looking at, so my only restriction when I decide what to do is, hey, is that time slot available to me? Do I have, if it's a day that I have to grade exams for my, class, I'd probably say, no, I can't do it if I'm trapped. But if I live an idle life, a life of leisure. I'm a dabbler. I don't do research in the conventional sense. I just pick up whatever interests me. And if there's nothing interesting, I just take a walk on the beach with my dog and no, do nothing. Doing nothing is vastly underrated. I think that, we spend too much time worrying about what do I do? What should I do? Doing nothing is often when I get my best ideas, because when you're doing nothing, your mind is this blank slate. So to me, this is a chance to kind of get my thoughts in order. So when I do these, it's as much about telling people what I think as getting those thoughts lined up. So what I said to you might show up in a classroom next week as part of a lecture. Everything is raw material to something else. And nothing in life is one and done. It shouldn't be. Everything you do should become something. It becomes part of a book. It becomes part of a post. It becomes part of a teaching session. And so to me, this isn't an hour and 15 minutes where I spent and it's done. And there is a payoff. The payoff will show up. I don't know what the payoff will be. I tell people, look, I spend an hour every day answering emails from people I don't know. These are not people in my class. And the reason I do it is, and many of these questions might be, I'm valuing a company in Tunisia. I have to use a tax rate. I've read your book. I don't know how to come up with a tax rate. And it takes me about 2 or 3 minutes to answer the email. And I'm saving some person somewhere in the world 3 days of work when I do it. And I look at things in my life. You talk about return on invested capital, return on time invested in your life. The way you measure the return is what change do you create? There's very little in my life that I do that matches that 1 hour I spend answering emails from people I don't know. No. So the measure of a life is how much change did you create? No, this is time well spent. So no, nothing more, nothing deeper than that, nothing altruistic. No Mother Teresa, it's purely selfish. And maximizing return on invested time.
Well, I mean,
I can't thank you enough for coming on. It was absolutely fantastic listening to you, and I'll be flattered if your next class you talk about the conversation that we just had. but thank you.
Might show up, yeah.
yeah. But
Thank you so much, Professor. It was absolutely wonderful talking to you.
Take care. Good seeing you.
Thank you.